After wild swings from President Trump, how can Europe handle the trade uncertainty? On Friday, President Trump announced plans to slap 50% tariffs on all EU exports. By Monday, he had done a U-turn and hit pause on those duties, giving Europe until the 9th of July to strike a deal. There's some evidence all the uncertainty is hitting economic confidence. On Wednesday, for example, inflation expectations in the Eurozone ticked up. Carsten Brzeski is Global Head of Macro at ING Research. Carsten, tariffs are on hold again for now, but is the data starting to show the uncertainty is almost as bad?
Well, the uncertainty definitely is bad. And the funny thing is, what the data also showed is that the first quarter in Europe was actually surprisingly strong. And how come? Because we had this front loading. So exports were front loaded, industrial production was front loaded as businesses were anticipating the looming tariff. So for the first quarter, you could actually say that Donald Trump made the European economy great again for just one quarter. What we're now seeing in the second quarter is indeed that this policy uncertainty is holding back investments, is holding back consumption, and is clearly weighing on the European outlook.
Christine Lagarde did suggest in a speech on Tuesday, though, that there might be opportunities to make Europe greater again, as you say, in money moving out of the US dollar. Is there, do you think?
Well, we've seen already that investors were looking for alternatives to the U.S. market. That is the sell-off we saw in the U.S. bond market. That was this idea that Europe could benefit from, I would say, the erratic policies in the U.S. And we've seen also that the European stock market actually performed relatively well since the start of this year. What ECB President Lagarde was hinting at was clear that Europe needs to do more. Europe needs to be really attractive for foreign investors, and attractiveness will come with stronger domestic demand, but attractiveness would also come with a really complete capital markets union, because we really need a very deep, fully integrated capital market in order to be able to absorb all these potential investments coming from outside of the EU to Europe.
She also clearly wants to see more joint debt issuance and not just for defence. There's some resistance, of course, particularly in Germany. What are the chances of more joint debt happening?
I think the chances are still very low. I think the best chances that I can see are when it comes really to this kind of project bonds, so joint borrowing for the sake of a certain project. We've had them already. This is the pandemic funds, the Next Generation EU, which was already kind of joint borrowing, and we could also potentially see this joint borrowing for European defense spending, but to really go beyond that, it would require steps forming closer to political union. It would mean also more kind of mechanisms across European countries for control. And I don't see that currently there is the political will across Europe to really go further towards a political union. So common borrowing will, in my view, be limited to really project financing, but not at a broader level.
Even so, though, if the euro does gain in use as a reserve currency because of what's happening to the dollar, what impact would we see?
Well, I think that is a very good question, because it also means a little bit be aware what you're wishing for. Because if the euro would become more attractive for foreign investors, what would this mean? This would also mean a stronger euro. We know this also from the US dollar experience. So if your currency is the dominant global currency, it means your currency is relatively stronger than it would be than without this position. So a more attractive European economy would also mean a stronger euro, which in the current circumstances, and in which Europe is still so much export depending, would be an additional problem for the European export sector.
Do you think the ECB is happy to let it move higher, or are they starting to worry about the cost to exporters, who are, of course, also facing tariffs?
Well, I think there currently is another safe haven, that is the Swiss franc, that attracts foreign investment or foreign capital if it moves out of the US. And we've heard what the Swiss central bank is actually willing to do. So the Swiss central bank doesn't like a strengthening of the Swiss franc as a result of more capital flows coming to Switzerland. And this is why they are, I think, no longer ruling out negative interest rates. So would the ECB really like seeing a much stronger euro as a result of a more attractive continent? My answer would be not really, because a stronger euro would also mean there would be even more disinflationary pressures, which then in turn would mean that there is a risk for the ECB to undershoot its inflation target. And then this would mean that the ECB would have to react with even lower interest rates in order to somehow cushion or mitigate the impact from a stronger currency.
That was Carsten Brzeski of ING. Don't forget, you can watch more videos on Reuters.com.